Hi guys, welcome to SavvyMoneyShow. Me, your host Sean. I apologise for any background noise. I am outside. I appreciate you giving up your time to watch this video. We're talking about stocks I'm picking up right now, and I hope you'll list any stocks you want to look at and you want me to do a video on. And don't forget, I'll be doing a Q&A fairly soon. Don't forget to drop a like, subscribe, and comment in the box of any questions. And if you look at the links down below, you'll be able to pick up a free share worth up to £200 from Freetrade, Trading 212 or Lightyear. Let's get into it. AIRO. They're a defence company that classes themselves as a holding company, so they pay less tax. So what they do is they go out, they buy other defence companies, then manufacture things like what's hot at the moment, drones, and they get a massive amount of contracts, and they only need one or two of these contracts which will sustain them. Now, on the face of it, the fundamentals don't look great, but they're not bad either. It looks like they're losing money. Their price to book is 0.45, but that doesn't do much if they're losing money. However, you see the revenue they're bringing in is 82 million, and that's costing them 30 million. And their EBITDA is negative 41 million. It is a company that is showing us losing money because they're acquiring other companies. They're also putting a lot of money in research and development, and so the free cash flow is negative 15 million. However, if you look at their balance sheet, if they didn't bring in anything more today, they would have enough to pay off all their liabilities, and they would still have enough for more than 4 years runway. Of course they will be bringing in money because they have contracts, but I just think it's one that's worth looking at. And we have heard about how much these drones cost, and how many are being used in Iran and in Ukraine. The next one is Grab Holdings. Now, Grab Holdings has made a moat for itself. I highlighted this when it IPO'd, and it tanked after the IPO. It didn't do well then, but then it had a few spurts up and down. It has a wide moat where Amazon has tried to come into the market over there and failed. So it's going to be very hard for anyone to take any of its market share. But even if a company did come and take its market share, you're going to get it could lose in one industry and it would still be able to survive with the other industries. It's growing quite a bit, because a couple of years ago it wasn't even profitable, but we can see how you have it's a negative 44 million, and we've got the fact that it's total liabilities are 5.2 billion and the current assets 8 billion, and 7.8 of that is in cash and receivables, so they can pay off their liabilities today. And that's the kind of company I like. Powerful liabilities today, and they would still have a massive runway if they wanted to. Of course, as a company, they would rather have the cash on hand. These two are going in my spec portfolio. Previous plays I've had in my spec portfolio, of course, have been Palantir, IONQ, Rigetti, IONQ at 3, Rigetti at 1.5, Prime at 125, Intelia at 6, CRISPR at 30, and Beam at 15. Now, also had other ones, but a lot of other ones, but the thing is, do not go out and buy this because I've said this. Do your own research. Now we're going for what I consider an AI stock, SMCI. Now this is one that's tied to Nvidia. Its storage is tied to Nvidia, and I've done lots of videos on them in the past. Its market cap is below enterprise value. It's got a forward PE of 12. I was buying it when the forward PE was 13, and price to sell is 0.73, price to book is 2.71. Now, why has it come down again? Because we were buying it in the 20s before, and then it shot up, but it's come down because it's had a margin compression, but that's a short-term thing in my opinion. It's also come down because it's got 16.5% short interest, which could trigger a squeeze. I have no concerns over this company, no concerns at all. The next one is Ceotronics. Now, it has run up recently, and this is a company that deals with audio, headphones, and I'm not even going to go into the last spec play that was in that, because that did hundreds of percentage points for us. Now, it pays a dividend as well. Why am I interested in this when it's a German company? It's had good earnings recently, and one of their products are that they do wireless headsets, is the wireless headsets that goes in helmets, and they just got a huge contract with the German military. And to tell the truth, at 97 million market cap, that contract is worth 2/3 of their market cap. It's based over years, so they're not getting it all in one go, but it's still good. the price to book of 3, price to sales 1.34 for a company that has a profit margin of 11, operating margin 17. It's really good, and I think there's quite a bit of room to run here. I don't want to go too deep on the defence sector because I have QQ still. I have sold out of 1 or 2 of my defence stocks as they become overvalued with all these wars on, and I do have room to put into a couple of spec defence stocks, but you see it's got 24 million free cash flow, and you can see that the current assets is 32 million against 14 million total liabilities. Now, one thing I don't like about this is that 5.5 million of it is cash, but from what I see is they are going out and buying more inventory. I don't like it usually when a company has a majority of its current assets in the inventory, because what happens if they don't sell that inventory? But when a company like this has a contract like this, they need to be going out and buying the inventory because they don't want any supply chain issues. They don't want to be going out buying getting the contracts with governments and then saying, sorry, I can't supply you with them. So that doesn't worry me so much, but it shows that the current liability is 3 million, so they can meet their current liabilities, and they have a lot of inventory on stock. They're making 24 million in free cash flow each year, and with that I like the way that they're paying down debt, keeping some cash on hand in case of emergencies, and buying inventory so they can stock up in case they get another contract. And again, another company like this, they only need 1 or 2 contracts to pay for the whole year. Of course, they also supply commercial as well with their headsets and all their other products, but I think it's one looking into. It's a shame that it's not on the UK or other stock exchanges. It's on France, Germany, and the usual European stock exchanges. Let me know what you guys think. Now we move on to Rightmove. This is a company that has most market share in UK. If you're buying a house, looking to rent a house, it's either this or Zoopla. Majority of people use Rightmove. When I was renting my property out, the agent I used both Rightmove and Zoopla, but they have a subscription-based service, and Rightmove is the best one in my opinion. They pay a dividend, which is only up, I think, 38% of their cash flows. I sold this before when it was a lot higher. I'm surprised that there's a PE of 16, because it's usually in the 30s, and I was buying it because it had such huge market share and it had a dip before and it came back, and I'm surprised this isn't. Obviously casualty of the SaaS versus AI, but I think it's overdone. You can see here the metrics: forward PE of 14.5, price to sales 8, price to book 41, which is a lot. But then you see the profit margin 51%, operating margin 66%. I mean, I just can't believe people are not snapping this up. It's like people said, they come to the market and said, look at our earnings, and people have said, well, sorry, your earnings are not good enough, AI is going to eat your lunch. And then they've gone, okay, well, as a vote of confidence, the board are going to buy shares, and each member of the board has bought shares. They've gone, that's not enough, because AI is going to destroy you. And I don't think AI will destroy you. And because when I've typed into AI an area, houses in an area, it's just taken me to Rightmove. And then they've gone, okay, we're going to build out our own AI products to go on our platform. And then people are going, that's no good, because that's going to cut in your free cash flows. So then they've just announced they're buying back 200,000 of their shares, and I think you will see that there. Yeah, there we are, 200,000 of his shares. And I just think what's going to happen is we're going to come through all this, and we're going to see that a company growing like this is just going to, people are going to regret not picking it up. And it is one I've liked for a long while, but I've thought it was overpriced. When it was the right price, I bought, and then I've had to sell because it just too big a profit on it. 226 million free cash flow, as I said. It's you can see here the total assets and the current assets both outweigh the total liabilities. You can see the cash and the prepaid assets. Now, the prepaid assets are where people have paid, as I'm sure you're aware, where people have paid for a service, they just haven't received that service yet. So my agent will pay to have it listed on the property, on the platform, until it's sold, and until it's sold is not classed as cash. Now, we reached a huge amount of people that I couldn't have reached without it, and it did get rented. But anyway, let me know what you guys are looking at. Of course, there's the usual ones like Adobe and Oracle that I'm also adding to.